Hi, I'm Dave,
And I'm Paul.
and we're going to challenge you to transform your financial future through the principles of the most profitable business in the world, banking.
We believe everyone should be involved in two businesses, the business that you're in and the banking business. Everyday people can replicate what bankers have been doing for centuries to leverage capital and build wealth through private lending.
Join us as we uncover the truths about money, expose lies and myths, and flip conventional financial advice on its head. Here we go. Paul, what's happening, man?
How are you?
I'm good. Busy with baseball. So, as soon as we get done here, I got to eat and run out the door to baseball. I think we got 2 practices and possibly 9 games between now and Sunday. So it's a busy time.
That's a lot.
It's like a crescendo at the end of the season where they just throw everything at you, and then it's like that. It's like the grand finale at the fireworks display. Yeah,
It's a lot of baseball for those young arms.
it's a lot of baseball. We were talking about that. Like they have a
a lot of
pitch
baseball
count
for
these
parents.
days. So you got to be. We've actually won a game because the other team went over their pitch count and the ump called a forfeit. So
Oh, wow.
yeah, we actually won a championship because of that.
Ah,
So that team did it twice. So was it on purpose? I don't know. Yeah, I think we're not counting, but
right.
yeah. So we're
Right
finishing up baseball, which has been fun, but it'll be nice to have a little more of a break here towards the end of the summer.
Yeah, it sounds like you on the, as the opposing team, you guys, it was beneficial for you to know the rules and know them really well.
Yeah, like Bill Belichick style. Yeah,
That's right.
Know the rules and use them. They're
Greatest
there for
coach
a
of all
reason.
time.
Yeah, well, he couldn't win without old Tom.
Yeah, I mean, it was kind of, yep, you're right.
Yeah. Well.
Of course, people thought he was overrated too over the years. Like, oh, he's overrated. Yeah. All right.
Yeah, hard to say that.
Yeah.
Yeah. Speaking of football, there's a good show. Me and the boys
Quarterbacks?
quarterbacks. We started watching that last night.
Yeah, I saw the ad for it.
Yeah, it's
Looks
pretty fun.
interesting.
Yeah. So, getting me pumped for football season, man. Not that I ever even watch a game, hardly. Like I get excited when football season comes around, and then I never get to watch a game.
I watched the Super Bowl. Yeah. So we know do you have cable or DirecTV or whatever? We don't.
No, of course not.
Yeah.
No, but because my team is really good, the Chiefs, they broadcast them all over the place.
Right.
So I get to see about half the games just on network television.
Right.
Yeah.
Awesome.
So yeah. Well, all right, man. Let's get going. I think we'll just do a Q&A episode today. We had a lot of good questions from clients and prospects over the last week or so in the meetings we've had, and let's knock some of these out. So here, I'll ask you the first one, and this is my favorite question. When somebody asks me this, I'm like, boom, he gets it, she gets it. Like, let's move forward. The question came today: how aggressive can my premium be? How would you answer that?
Yeah. Normally, I would probably give them kind of an underwriter answer, and it's tied to your income level, right, and your age. So the older you are, the less working years you have left, right? Theoretically, according to an underwriter, right?
Yeah.
Typically 65-ish, 70-ish, maybe, but generally 60 to 65 years old is kind of considered, the end of the working life to an underwriter. So that being said, if you're 40 years old, an underwriter will probably allow you to have around 25 times your income and death benefit. And the way we design these policies, Dave, obviously we kind of reverse engineer them. We don't generally ask someone what they want for a death benefit. We ask them, all right, well, how much, we have a death benefit goal, of course, but let's see how much premium you have in order to get close to that. And then there's some things that we can do with some term riders and stuff to get to that death benefit goal. But generally speaking, we plug in the premium amount and it spits out a death benefit.
Right.
So as a simple example, as relative to income, if you're making $100,000 you can expect the most an underwriter will allow you to pay in premium is going to be somewhere between $15,000 and $25,000 in premium per year. 15 to 25%, in other words.
Yep. And I have had them accept, upwards of 30% based on your income.
Yep.
So
now, yeah. So if you've got a client that makes, $1 million a year or $10 million a year, obviously, if we're talking to them and you make $10 million a year, well, can you live off 5?
Yeah.
Yeah, I think I'll be okay, right? There's some allowances there, obviously, but again, we've talked about it where someone who makes $50,000, they're going to allow you to pay $25,000 in premium. That's half your income, right? That's half your gross income, right?
Right.
So no, great question. I think that gets to the point that someone that really gets it, like you said, and it's kind of a different way of asking, instead of this is how we gauge your understanding of IBC and knowing what's going on is typically people who have a limited understanding are asking us how much should I pay in premium every year or every month?
Yeah.
And the real question is how much can I pay?
Yeah. So, and I like this because this came from a military guy, and how aggressive can I be, which I love. My answer to that is, hey, if you've already got the discipline to save and you don't have any consumer debt, then you're only limited by how aggressive the life insurance company allows you to be.
Yep.
That's your limit. And I'm fully comfortable with you approaching that limit if those other things are taken care of. Now, if you've got, you're hardly saving anything, or, Parkinson's law has caught up with you and your expenses have risen to meet your income, and you have some consumer debt, then I'm not going to recommend you go that aggressive at all until you get some habits in place and some discipline in place to fix that. So take care of that, and then go aggressive. But realizing you can always add another policy down the road.
Yeah, so that's right.
Yeah. Yep. So love that question, man. Great question. And it tells you that this person gets it.
Yeah. And that's someone that you've kind of been talking to for several years now.
Yeah. And it would have gone forward a lot earlier, but living out of the country makes it very difficult. Insurance companies don't really like to underwrite you if you're living in another country. They want you to be here on American soil. So,
yep. Yeah, that's exactly right. And we've run into that a few times, unfortunately, with clients. So,
right.
Okay. Next question. How quickly can I get a policy going? Because I need to buy a car right now, but I want to get my cash into a policy first. What are my options?
So that's another great question. And I would always dig into that a little bit more, like, is this eager investor syndrome, which you're buying a car is not eager investor syndrome. But really what this question comes down to is somebody who's read the book, listened to the podcast or whatever, but they get the idea that, man, I've got this cash saved up. I do not want to spend this cash. I hate the idea of it now that I understand this different view of money, and that I finance everything I buy. If I pay cash, I've lost the ability to earn interest on that cash for the rest of my life, and I don't want to give up that opportunity. There's an opportunity cost to paying cash. So this question comes from a good spot of understanding and wanting to get that cash working, locked in, earning for them uninterrupted for the rest of their lives, and then leverage it to go buy that car with cash. So in this situation, like if you can't wait, if you need to go buy something, I would look into financing it. Save your cash, save your capital, go through the underwriting process, which could take 4 to 6 weeks. Could be quicker, could be longer, but have the patience, go through that, hold on to your capital. In the meantime, you can finance that car purchase, and maybe you make one payment, maybe 2 payments, and then you can fund your policy. A couple weeks later, you can access that cash value, take out a loan to go pay off that loan with the bank, and now you own your car free and clear. And that exact same payment you were making to the bank every month, because you already fit it into your budget, you can make it, you now just redirect that payment back to your policy, every month and start filling that back up. So,
Yep. Love it.
yeah. Yeah. Don't be afraid to use bank financing to hold on to your capital in a situation like that.
Yeah, exactly right. Before we hit record, we were talking about the construction loan that I'm going to have here in a few months, and the options that I had with that to kind of hold on to my cash longer than I thought I was going to be able to. I thought I was going to have to bring 20% right out of the gate, but that's not the case. So, no, I love that. And then we covered in an episode, Dave, where we talked about your new truck pretty early on in the podcast, I think.
Yeah.
Where you did exactly what you just explained, except you added another step. And I actually think you kind of put it like this, where you created a passive income flow from some opportunity to then make the payment on your truck, which you used, the dealer financing or whatever. So that's another option that this person could also do, is adding that extra step. But either way works, right?
Yeah.
Like, there's no bad decision.
You're the banker, right? The banker can do.
You can do whatever you want.
Whatever you want.
It's like being an empty nester. We can do whatever we want.
Yeah. Yeah. Well, I won't know what that feels like for quite some time, but
Nope.
Yeah. Yeah. But that hopefully, and that's a great scenario where, hey, yeah, let's get this cash in there and take a loan immediately. We don't advise people take loans immediately, but if it's the difference between letting go of your capital for the rest of your life versus putting it in here, locking it in, and then leveraging it right away to go make that payment, that purchase that you have to make, or you really need to make, that's a better option. Get that money working for you for the rest of your life.
I know between the two of us, we've likely had several clients who lacked the proper understanding or were impatient or whatever. And, months later, they come back and say, Paul, you were right. That money that I directed over there to do that one thing should have gone into my policy as single premium first.
Yeah.
And I'm like, well, we talked about that, and you didn't want to do it. So
yeah, all you can do is lead a horse to water.
That's right.
Right.
Yeah, that's right.
It's caught, not taught.
So when I recommend something, here's what I told someone fairly recently. I was like, listen, when I'm recommending a policy design or a certain premium flow, or I'm doing it as if I'm designing this for myself.
Yeah.
And my own family's needs. No different. So anyway.
Yeah. No, I think the same thing.
Yeah.
Right.
So this question came in. I'll take this one, Dave. And you can answer too, because I'm sure this applies to you as well. But this came from one of my clients. Do you have any clients who leverage their cash value for stock market investment? I'm sure I do. In fact, I know I do. I have several clients that love the stock market and they think it's the greatest thing ever. And they also do real estate as well, but they're just very savvy people. So of course. But this is because they understand that their policy or system of policies is simply the foundation of their wealth. All
right.
money's flowing, it flows in, it flows out, it flows in as premium, flows out as loans, goes back as policy loan repayment. And it's just, the cycle continues. The only difference is every year is they have a larger and larger pool of capital to work with, right? So for sure, I also have a client that's very savvy, that has a portfolio where he uses dividends to pay some of his premium. So he has a fairly large brokerage account and is a very savvy dividend stock picker, and he pays premium like that partially. So
yeah.
So yes, absolutely. Again, you're the banker. You do whatever you want.
You can do whatever you want.
Stock market, go do it.
Yeah, and I have one prospect I was talking to who has like an employee stock purchase plan. Right. So every quarter he can buy stock at a 15% discount. And then the very next day he can sell it and make 15% on that.
Right.
And he's like, I could fund my policy if I calculated how much I can buy every month and the 15% gain on that, or every quarter. He's like, I could fund a quarterly premium with that gain. I was like, well, now you're thinking like a banker. That sounds like something a banker would do. So there's all kinds of options. But yeah, I had a guy, a client, who likes the stock market. He likes to pick his own stocks and do that as well. He's a pilot, so he's got a lot of extra time on his hands, and he spends it getting smart on the stock market and following, trying to make good decisions on that. Well, he's like, I just don't want to stop doing that. And that's a great thing. You don't have to stop doing what you're doing right now. You can just do it in a better way, a way that creates more efficiency of your dollars, creates more certainty and more safety without adding any risk whatsoever. So you just add it. It's like a layer in between. It's like the meat in a sandwich, man. You got, where your money is right now, where it's going to be. Just put it here, right in the middle for a little bit first, capture it there, and then you can, go use it for something else.
Yeah, exactly right. And Nelson talked about, changing the sequence of his spending pattern, basically, right? And we've said it a million times on here probably by now, but your money is going to go do what it's going to go do. Buy a car, finance an investment, buy a house, finance college, whatever it is. Pay for a wedding, in your case, like a bunch of weddings. Before it does all those things, it should be premium first.
Yeah.
Right? And it's really that simple, folks. Minus the startup costs of, about 10 years of startup costs for your policy, let's just say that's a fair estimate with the policies we design. That's just, you have to accept that, right? And it's not something that's concerning. It just is, I guess. It's not, but man,
it's interesting. People will balk at something like that, yet there's still 45-year-olds paying off college loans that they acquired over 20 years ago. So how about that for a startup cost?
Oh my goodness.
How's that startup cost going? Like, people don't even give it two thoughts that I've got student debt. I have to go to college, and I'm going to spend the next 20 to 30 years paying this off. Like, okay. But that's a startup cost that taking you a long time. This, we're talking 8 to 10 years startup cost. And you get to use that money in the meantime.
We should probably have one of our doctor clients on. The most recent one is what I'm thinking of in particular, because a lot of mine are military docs. But and how much of a delay there is, because they're in residency, and then they're an attending, and then they make a little bit more money, but not much.
Yeah.
And then they're finally they get to wherever they're going, private practice or whatever they're doing. But they're so delayed in making money. I think attorneys, to an extent too, they're in school for so long in a lot of cases that there's such a huge delay in generating an income, and then they have a massive amount of debt.
Right.
Nowadays, several $100,000 at age 30.
Ouch. Yeah. And then, who are their friends? Doctors. So, who are they? They're a doctor. So you got to live the doctor lifestyle.
Oh, you got to be that
right?
country club.
You got to go to the country club, man. You got to drive the BMW, the Mercedes. You got to have that nice house. And it's a sad situation, I think, for a lot of medical professionals who go that route, who start living that, it's Parkinson's law, man. You got to keep up with the Joneses.
Yep.
And it catches up. I think, I don't know. I've heard, dentists are one of the most prone to depression. The professions that are very prone to depression, is dentistry and being an attorney. And I think a lot of that is actually just the fact that nobody wants to see you. Nobody's happy to see you and pay for the services that you offer. Right? Because it just means they're either going to be in pain or they're in trouble somehow. That's probably a lot of it. But another cause that I've heard, speaking specifically for dentists, is that you get these young kids out of college, they're dentists now, and they go work for somebody who owns their own practice, who's driving the Mercedes, who's living that life, man, who comes into the office 3 days a week, and has that disposable income or discretionary income. I don't like the word disposable. I wouldn't dispose of any of my income, but and then they feel like they got to do the same. So,
right.
Yeah, you don't.
Nope.
Just live well below your means. Enjoy your money, but yeah, you don't got to do that stuff to impress other people. Anyway, got off on a little tangent there. I don't even know how we got there. Here's another one. Hey, I've got a lot of cash, and I was talking to somebody recently. They got a lot of cash. It's saved up. They want to put it towards just paying the premium on their policy over the next several years, maybe 3, 4, 5 years. So they don't have to think about it. And then by the time that's done, maybe their cash flow situation is freed up. They got more income, they got fewer debts, and they can fund those policies out of pocket very easily. What are some options for doing that? Like, where would you put that cash? Maybe not you, but what are some options for clients who want to do that?
Yeah. Well, I think my first stop is, following the, Nelson's teachings is, don't do business with banks. So my first stop is always going to be the mutual life insurance company of my choice, right? Some of them offer these riders where you can, put up to, let's say, 10 times the annual premium into a rider. And then your policy's basically paid up for the next 10 years, right? And then they kind of discount, it bears interest, it'll generate a 1099, but it's basically discounting the cost of the policy for you,
right?
As it earns, because it's earning interest, right? And that's kind of how it's treated. So that's one option. You could put a ton of cash into one of those riders. And I've had clients ask, and I was like, well, if you have like 2 years of premium, or, there's different riders that we can do that with. So I think that's personally my first choice, because I'm helping make the company that I'm part owner of profitable by giving them more capital to work with. And let's face it, it's likely a safer place to put the money.
Yeah. Right. Then just your local bank, where it's just going to sit and you just draft it, and then it's, out of sight, out of mind, right? If you just put it in a bank account, that's not out of sight. So chances of you going to pilfer that for something that comes up, whether it's an emergency, an opportunity, or just consumerism, is a lot higher.
Yep. I think I like the out of sight, out of mind of having it with the insurance company. It's not illiquid per se, but you'd have to go through some steps to get to it, if that makes sense.
So it could be a really good option for people who maybe inherited some cash they weren't expecting.
Sure.
Or maybe you want an older couple wants to get policies on their children, their adult children, but maybe they don't trust them to fund it after they're gone. Something like that. They could set that money aside in one of these riders and have it fund the policy for them. Who knows?
Right.
Options.
It begs the question, are they insurable if they're that irresponsible? Yeah, maybe.
Yeah, maybe. But okay, cool. Here's one that came up recently. I really like this one, and we've heard it more than once. Mm-hmm. But Paul, should I diversify my life insurance policies with different companies? Doesn't that make sense? Like, I diversify my investments. Shouldn't I diversify my life insurance policies as well?
I don't particularly think so, but it's kind of like what we were talking about before we went hot. I liked how you kind of put this was, Dave said, what brand of car do you drive? I look around my neighborhood, there's a lot of Hondas and Toyotas. My neighbors have 2 Hondas over there. I just looked out the window. They've got a couple of Toyotas, and then there's some Subarus, right? And they're matched. There's like 2 of each. So
right.
People I buy the brand or the model or the brand, let's say the brand that I perceive gives me the best value. Like, I like Ram trucks. I think they have the best ride quality. They're the best motors. Cummins diesel is obviously the best diesel engine out of the 3. Sorry, Ford, GM. I'll probably get some hate mail, but everyone knows that's true. Cummins is the only real diesel motor out of the 3. But anyway, so I have my favorite and preferred mutual life insurance company. And I think you do as well. And that's where all of my personal policies are with. Consequently, it's where 99% of my life insurance business is through, because I perceive it to be the best company to do IBC business through.
Yeah.
And I'll leave it at that.
I like that. So, another thing about diversifying life insurance companies, I guess the question would be why? Is it because of the dividend? Like one company might have a higher dividend one year than another. Well, studies have been done, and really the dividend makes very, very little difference because they're all so competitive. The healthy mutual life insurance companies that would be good for infinite banking, so competitive that dividend is really a non-factor. The fact that they're paying a dividend is what matters more than anything. Whether it's 5.2% or 4.9 or 6% even doesn't matter, because that's just a small piece of that overall equation on what a dividend actually is and how many dollars it puts into your cash, shows up its cash value.
Yeah, they're unrelated.
Yeah, how many dollars show up is unrelated to the dividend rate.
Correct. So, and we've probably talked about that before, but
we have an episode on it. Yeah.
Yeah, I mean, it's the gross dividend rate. I find it mildly interesting. I just care that, like you said, that I get a dividend, but and then do the companies all calculate it the same? No, they don't.
Right.
There's not really an industry standard for it. So
yeah.
But no, you bring up a great point. If you feel more comfortable, I mean, ultimately this is up to you. If you feel more comfortable diversifying, fine. That's we've been sold that word diversification through the investment world. I would say you got to diversify, and
which the wealthiest people don't.
Yeah.
Yeah. But
they do insider trading.
Yeah. But diversifying for a company that maybe it'll fail, and then at least I have one policy that's good with another company. If companies fail, other insurance companies have to step in and make those policy owners whole. It's regulated at the state level very strictly, and all these companies pay into a fund that and basically are required to pick up the slack for another company that failed.
Yeah,
and take over those policies.
It's pretty awesome. And
So I'm with you. I don't diversify. I do have policies with 3 different companies. Yep. However, the majority of my policies and all the policies I've acquired in the last, say, 9 years have come from one single company, the company that I do all my business with, or the majority of my business with right now.
Yeah.
Barring some necessity because of a client situation or health reasons or something.
Right.
Yeah.
Yep. And I like the company that we use. It has very, very strict underwriting, sometimes a little too strict in my opinion, but
yeah.
It is what it is.
Yep. It's and it's highly used by IBC practitioners, which are the biggest producers at these companies.
Right.
Yeah.
That's true.
So, and they support us. They support what we do. And that makes a huge difference, because some companies don't, right? Some companies say you can't use the word bank or banking when you're talking to potential clients. And they make that very clear. That's their right. But, other companies are completely fine with it. So,
right.
Yeah.
Okay. So last thing on our list here is something that came in from a recent client here is, so Dave, some companies allow us to do, we have base premium, we have paid up additions premium that we want to pay every month or every year. But on top of that, some companies allow a single, one-time only lump sum in the first year of the policy's life. And a lot of people they immediately think, oh, I got to pay this with all the other premium right away. But that's not true, is it? It's
right.
You have 364 days after the policy's in force, right, to pay that lump sum. So what this allows a client to do is, let's say they're a good saver and they're like, you know what, Paul, I told you I could save this much. But actually, by 11 months from now, I'll be able to have this much. And we can build that space into the policy to accept a higher premium, which buys you more. It would be a term death benefit, but it would cover that, maybe gap of insurance coverage that you might have and death benefits. So,
yeah. And not only that, it's not just your savings rate, but maybe you have quarterly bonuses from your company.
Yeah.
Or an annual
Some
bonus
sort of
that
windfall.
doesn't really correlate to when your policy is started. You start your policy in August, but your bonus doesn't pay out till February. Like, hey, you can wait until then to fund that single payment. And then what else does that do? It creates more death benefit, more cash value, and a greater pool of capital earlier than otherwise. So, there's trade-offs. You may be able to fund less paid up additions over, later on in life.
Right.
But it allows you to capture that capital right away, right now, and get it, put it to work, earning those compound returns for you from that day forward. So yeah, I love that option.
Yeah, no, it's very liquid, and we do it all the time. So just know that what I generally tell people, Dave, is if you dream it and it's possible, we'll do it if it makes sense. You'll get our best recommendation, because a lot of people do have cash. Oh, and let me harp on this for a second. Like, your emergency fund, my opinion, ought to be that type of premium, probably. It should be in your system of policies or your first policy or whatever. But if you open up a policy with high premium, then you're like, oh, I got another $150,000 over here in a savings account. Like,
yeah.
Why?
And that's why it's important for me to get all of that information from everybody during the application, and then during the fact finding portion of the application and underwriting process. Is like, I want to know where your cash is, how much is available, so I can provide the best recommendations to you. You could take it or leave it after I offer it, provide that recommendation. But unless we have that truth data, I can't be as useful to you as I otherwise could be.
Right. I'll have to tell you after we go offline. I had a call with a prospect recently, and as we dug in, he got a little more comfortable. And I work with this guy's brother-in-law who sits behind me. It's funny. He lets the cat out of the bag of how much money he's got in the bank, and I'm just like, oh, good Lord, buddy.
Yeah,
you're killing me.
Yeah.
So
there is such thing as having too much money in certain places.
Yeah, no doubt. And he's, single guy doing very well, so has no debt. But it's just, come on, man. Like, there's way smarter things to be doing with this capital.
More efficient and productive uses of your capital. Yeah, that's what this is all about. Just increasing the efficiency, the productivity, and the safety. Really.
Yeah, let's get that 100 knot tailwind.
Yeah, there you go. Well, right on, man. Well, hey, it's time to eat some dinner and head off to baseball. So, I guess we'll pick it up next week.
All right. Well, good luck to the boys, and yeah. I'm gonna say it this time. Ready? Until next time.
Control your capital.
Or somebody else will.
Hey, thanks for listening, everybody. If you'd like to have a conversation with us to see how you can become your own banker, or if you have any questions or topics you'd like us to tackle on a future episode, please send us an email to davidandpaul@theibcguys.com.
And subscribe and leave us a review if you're on Apple. Follow and leave us a 5-star review if you're on Spotify. And please share this with your friends. We'll see you next week.